depend on it, I guess.
Yeah, we don't build our clients' financial future on that kind of what I call speculation.
Mm-hmm.
So we build globally diversified portfolios. They have 9,000 plus stocks. They're effectively diversified.
Mm-hmm.
In contrast to the real estate market, where we can find private syndication managers in real estate who have 20 or 30 or 40 years of track record of outperforming a buy and hold of an index of real estate portfolios. Mm-hmm. So if we look at what the real estate market produces, you could look at the index and say it's about 6 to 8% per year. Mm-hmm. In contrast to private syndication real estate managers who have in the past produced returns in excess of 20% per year for, a long time, yeah. 20, 30 years. So I would...
So most investors, okay, so an exception maybe a Warren Buffett, but I'm not sure. In other words, you don't have that much of an impact on what the company is doing in order to enhance the returns. But you can do something with real estate to actually create the conditions for an enhanced return.
Yes.
For example, rehabilitating a property. Okay, so you buy an apartment complex, it's under rented, practically empty, whatever. You go in, you rehabilitate the property and upgrade it and get it rented up. So doing those activities, yes, which you can do over and over and over again for properties, and many people have, you have created a value there, and there's an activity that you can do that will do it, and that's predictable, fairly predictable. And so that's different from what can typically be done for a stock, other than you're making a bet, if you will, on a particular company that you believe in Steve Jobs, that he's going to be continuing to come out with the next iPod. Okay, so why don't you go on from there?
Good. So real estate offers the opportunity for me as the financial advisor to search the marketplace and find those managers that really can pick real estate addresses, manage them, and sell them at a profit greater than what the general market of real estate investment is producing. So our clients have been doing that for 12, 15 years now, and using managers that have produced the kinds of returns that I spoke about.
Pretty exciting. Okay, so what are the differences between the public and private real estate markets, and what are the advantages and disadvantages for each?
Well, to invest it, for the average investor, we've had clients come in to us who have owned a piece of real estate. Typically they bought it in the 60s, 70s, 80s. Right. They paid $50,000 for it. It's now worth, well, it used to be worth $1 million. Now it's worth $750,000. The growth rate on that seemed very great. But we've been able to analyze that and show that the average growth rate here is probably in the 7 to 8% range. Many of my clients,
when you compound things out,
compound it out, yeah. So the same is true in public real estate. So investors can buy a real estate investment trust.
Yes.
That's a corporation where all the investors put their money inside, and the manager buys literally hundreds of addresses across the United States. He'll buy commercial properties, focus in on, let's say, just commercial properties or just multifamily apartment complexes or whatever. And what we see is that those REITs over a long period of time produce about 6 to 8% growth. And in any one time frame, it's higher or lower due to stock market variations and the public's perception of that. So private syndicated real estate, in contrast to the public REIT marketplace, private syndicated real estate buys just a few addresses, 1 or 3 or 5 addresses in a private limited partnership.
Yeah.
And that general partner is buying and managing and selling those properties.
Mhm.
The public REIT offers liquidity. You can sell the shares of that trust daily.
Yes.
The private syndication is not liquid.
Right.
Typically, the qualification for the investor is that they must be called accredited, which means they need to have $1 million of assets under management and a few other criteria. So private syndicated real estate typically has less liquidity, more risk because it's got less addresses, but much higher expected returns. Twice as much normally as what you would expect in the public marketplace. And there's no guarantee of that.
Right. Okay. So maybe this fits in a little bit of what you were talking about before. What is the role of time for holding real estate and measuring the returns?
Yeah, good question. It is quite common, I think, for you to hear also, Mike, that a client walks in and the classic family, they bought the home 20, 30 years ago. They've now purchased a second home and they're renting out the first home. And they paid $50,000 for it, and it may be worth that $750 that we said earlier. And as far as they're concerned, the growth rate on that has far exceeded what they've done with anything else.
Because they probably haven't done anything else.
That's normally true. So we could talk about the returns in the stock market by the average investor. Normally, the average investor gets about a quarter of the returns of a simple buy and hold of the stock market. And the reason is that they're in and out of the market, run by their emotions.
Yes.
But they can't sell their real estate as easily as they can their mutual funds or stocks.
Right.
So they buy and hold it. So because they buy and hold it, they get a better return in their real estate than they might have gotten in their stock investments. But the truth is that the stock market returns average about 10%, and real estate is quite typically less than that. So buying real estate and holding it normally produces very good returns for the investor. But if you bought and held stock, you'd have better returns than you did if you bought and held real estate. And what we do for investors, for our clients in private syndication, we do not buy and hold. So we buy a piece of property, manage it extremely aggressively, add value, and then sell it.
So it's usually like on a 5 or 6 year horizon for.
We project 5 to 7 year hold periods
Yeah.
for private syndicated real estate. That's true.
Yeah. So.
Some are shorter, some are longer, and there's no guarantee.
Right. And then people have to decide what they're going to do at that point. Are they going to invest in the next project, maybe try to put together a tax-deferred exchange or whatever? Okay. Okay, so maybe before, I'm not quite sure exactly about where we are now, but what are some other alternatives as far as some of the investment programs that you've done?
So we have put together a master fund. The master fund allows our clients to invest a lump sum into the master fund and then diversify their portfolio amongst alternatives. So earlier we described alternatives as anything but stocks or bonds. And I said that clients went through the last 10 years and had 2 recessions, approaching or exceeding 50% in the stock price. So now what we talk with clients about is, if you buy and hold the stock market over your lifetime, you're going to earn about 10%. But you're probably going to suffer however many more recessions that we just did.
You're going to see. You're
You're
going to
gonna
take that
see
roller
it.
coaster along the way.
And if you're comfortable with that, then there's nothing wrong with buying and holding our risk-managed portfolios.
Yes.
However, if that was uncomfortable for you and you don't want to do that again, then let's look at allocating part of your portfolio to the alternative space. So clients are choosing to put 20, 30, 50% into alternatives. And if alternatives are anything but stocks, we've been using managed futures, real estate, private equity, business startups, timber, okay, and some notes.
Mm-hmm. So an
we're,
example of a note, okay, now see we've got about 3 minutes, good.
okay,
So an example of a note, so people get an idea, is basically it's a private investment, if you will.
yes,
Where instead of investing in stock, because the idea with stock is you don't know what your return is going to be. You know, it depends on performance and so forth. In this particular case, as I recall, again, loaning to an entrepreneur, he uses the money in his business, he pays a good interest rate, but also then there's an equity participation.
that's one way to do it. That's
Yeah.
correct.
Yeah.
And there's a real secondary market for debt instruments right at the moment, and huge discounts are available.
Okay.
25 to 50% discounts are available.
Right.
So
And one thing related to this is these private mortgages or private lending. It's a really interesting, or it's favorable for like retirement accounts. So you avoid unrelated business income and other issues by basically you're just getting, you know, dividends and interest. Those things, there's not a problem in these retirement accounts. So it eliminates a lot of accounting and reporting headaches that you have. Because
Yes.
right now there's a rage that's going on. I don't know if you know this or not, but as far as investing in real estate using retirement accounts, and you know, it's okay as far as it goes. But I prefer to see people investing in real estate, but meanwhile investing using loans from the retirement accounts, and makes life a lot easier for us tax people.
good.
So
Good recommendation.
Okay, so Craig, I think we're getting into the last. Oh, well, I'll give you 30 seconds for
30
maybe
seconds.
some final words of wisdom here.
Final words. I would say that hiring a fee-only advisor to work for the client, not the big corporation, is in our observation, our experience, added significantly to what the client can perform. And looking to build a risk-managed portfolio following Nobel Prize-winning methodologies has worked for our clients. And we strongly encourage clients to do that in their own portfolio, following their professional's advice.
Okay.
So we have at the Family Wealth Consulting Group, my wife and my daughter and I, and we're working closely with clients in helping them build a legacy and manage their portfolios, building risk-managed portfolios.
Okay, Craig, thanks again for being my
Mike.
guest. It's a pleasure having you here with me. Folks, I hope that we've given you something to think about these days, again, because of what's happened in the stock market, of people talking about their 201ks and so forth, that people are looking at alternatives and thinking about, you know, what should I be doing? Part of what I want you to know is that there are people like Craig here to help you along the path, and you don't have to just do it alone. Okay, so with
Thank
that, I hope that you've enjoyed this program, and hope you can join us next time on Financial Insider Weekly.